And I guess a lot of people have these common questions. So, Asan, it's a really good job that you set this seminar up, though,
Yeah.
because like everybody wants to buy a property. People want to buy. They're interested in buying, but they don't know the first know-how and how to. I mean, some people might. I don't know if anybody here has ever purchased a property, but if not, then today's presentation will give you a very good idea on what the steps are, especially with the aspects of the mortgage portion. I'm sure the real estate asset is very knowledgeable, but with regards to applying for a mortgage, I'm going to give the floor to Nash. We've put this presentation together. Each slide, Nash will take a few minutes to explain. And like Asan said, once we're done, the floor is open for questions. We're happy to answer your questions.
Yeah, so I guess for a first-time buyer, what I find most people do, they'll go straight to their realtor first and think they can go shopping and basically, usually they're wasting time. They're wasting the realtor's time, they're wasting their own time because they don't know how much they can afford. So the first step is let's see what you can afford. So here are a few lenders that we have. We've got all the big banks that you can work with, as well as other trust companies and alternative lenders. Alternative lenders would be for people that maybe don't have the best credit, so we can help people with that.
And we'll get into that on the next slide. We'll talk about
okay. So yeah, these are
all the aspects. Exactly.
They're like a small scope of our lenders. We've got over 60 different institutions that we can bring you to, and
sometimes people don't know. They don't know. The first thing they think about when they think about going to the bank and applying is they think about the big six: the TD Bank, Scotiabank, RBC, BMO, CIBC, and National Bank. In our channel, in the broker channel, we actually deal with Scotia and TD. But then, like Nash said, we have a host of other lenders and alternative lenders, including some credit unions that also offer mortgage products as well.
Yeah, and actually, sorry, man. It's really interesting to see that, like RBC, for instance, if you see on our slide there, it says Equitable Bank is one of our lenders. So in the background, like RBC is an investor of Equitable Bank, and like all these big six banks are actually in the background funding a lot of that money. But we actually, sometimes we can get better rates, better deals through going to like an Equitable Bank or an RMG compared to when you're regular big six.
Okay. So the next slide.
Yeah.
Aston? There you go. Okay. So Nash, you can touch on this.
Yeah, so your first thing is when you want to buy a house, credit is number one. Ideally, you'd like to have, especially if you're putting less than 20% down, you're going to need about a 680 minimum credit score. And the way that you keep your credit nice is obviously pay it on time.
I think what we should do is we should first just touch on this slide. So Nash, sorry to interrupt you. So these are the 3-4 basic things that a bank wants to know about you before they extend credit to you. So first is your credit score. The second is your assets and your liabilities. And the third thing is your income. So we'll go a little bit into each one, but I think the first thing, like Nash was saying, is the credit. So Aston, if you want to run the next slide. There you go. So Nash, go ahead.
Oh, okay, so here's your credit. So yeah, and a nice little tip on how to keep your score up there is try to stay away from using 50% of your limit. So if your limit is $2,000, try and stay $1,000 or less per month. Don't go over your 50%. And there's a common misconception that I see where people are like, oh, you know, they get this offer to increase the credit limit and they're scared to accept it. But you shouldn't be scared. That's great. You should accept it and take it, because then you can spend, if you need to spend more, and you're below that 50% threshold of using it. So don't be scared to
having a high limit is okay,
Yeah.
as long as you maintain your balances and just make sure that you're always paying your bills or paying your payments on time.
Yeah, and it looks good in front of a bank where, if you've got like a $30,000-$40,000 limit, you're not using it, you're not at the max, you're using a little bit of it. It looks good on you. It shows that you're responsible. So yeah, don't be afraid to take those limit increases.
And we've outlined some of the different types of credit products for some that may not have access to all these credit products yet. But credit cards, unsecured line of credit, a car loan, a student loan, a bank loan, even a mortgage on an existing property or a secured line of credit, these all count towards credit products. So if you have any of these, when you go to apply for a mortgage, this will show up on your credit bureau, and the bank will actually review the history and how you've maintained these credit products.
Yeah, and ideally you'd like to have at least two credit facilities, we call them. So maybe a credit card and a car loan, or two credit cards. At least two minimum is what the banks like to see.
We have the scores on the side, how your credit scores are, I guess, graded, if you see, and it starts all the way from 300 being very poor. Sure, nobody ever wants to get there, to over 850 being a very good score. But generally, you'll find majority of the population are usually between the 670 to the 739 are good, and then you have your very good and your excellent. If a quick tip, we put a link over there. If anybody ever wants to check what your credit score is, there's two credit bureaus that banks mainly use. One is Equifax and the other one is TransUnion. If you've never checked your credit score, or if you have, it doesn't hurt to check it periodically. See if there's any, because sometimes information can get reported on there that you might not be aware of, or maybe your address is wrong, your name's spelled wrong, your date of birth is wrong. So if you've never checked your credit score and you're interested, you should go to Equifax.com, and it's pretty straightforward signing up. I think it's a small fee that you have to pay, but you can download your credit report, and it will give you a very good indication of how the banks look at you if you're interested in applying for a mortgage.
Yeah, I would look more closely at Equifax than TransUnion. That's what we use when we pull credit. Well, we use Equifax, so that would be the most accurate one.
Next slide. Nash?
Yeah, so assets and liabilities. You definitely want to have more assets than liabilities when you're getting a mortgage. Your assets are, cash, savings in the bank, RSPs, stocks, and also for down payment, if your family is going to be giving you a gift, that's allowed, and that counts towards your assets. And they can actually gift you the entire down payment if they wanted to, or a portion, and it's totally okay with the banks.
One thing I can note is that you are allowed to get a gift from a family member to put towards the purchase of a property. However, the banks will only allow gifted funds on a property that you're planning to live in. If you're buying a property for an investment, or you're planning to rent it out, then those properties are not eligible for gifted down payment.
Yeah, you're in a different ballgame then, because if you're an investor, you've got to show that you've got the assets to be an investor, and if that renter doesn't pay, you've got the assets to cover that rent until you kick them out and get someone else, right? So yeah, rental properties are a different ballgame. We're kind of more touching on first-time buyers.
We're touching on first-time home buyers, correct, exactly. Another point is it's important to have money left over after you put your down payment, because Afsan will also attest to this, that there is extra costs that come with buying a house. So once you get your mortgage, there could be land transfer tax, insurance, legal fees, and maybe any other small cost like repairs that might come in. So it's important that you don't put every single dollar that you have or you're being gifted into the down payment.
Yeah, so basically, if you're outside of Toronto, because there's only one land transfer tax outside of Toronto, I think it would be safe. I usually use 1.5% of the purchase price, and that amount would be your rough estimate of your closing costs. If you're in Toronto, that percent is closer to 3 because you got to pay a double land transfer tax. So
safe to say between 1.5% and 3% to have aside off your purchase price.
Yeah, on top of your down payment.
On top of your down payment. Okay.
Yeah. And closing costs can actually be gifted as well. So if you have your own down payment, but you don't have the closing costs, totally okay. You can have that gifted. Even in some cases, you can borrow it if your income is high enough. But.
If your higher income is high enough. So income, this is very, I think this is very important slide. Nash, if you want to maybe touch on this.
Yeah. So your income, the way the banks like to look at income is, if you're a salaried individual and you've been at the job for a long time, all it would need is an employment letter stating your role, your salary, how long you've been there. And they might ask for a notice of assessment of your last year's income. And they'll use basically your salary. If you are an hourly worker, they will take your last 2 years of income that was reported on your T4 slip, and they'll take an average of those last 2 years. And that would be your income in the eyes of the bank. And then for self-employed, they're going to use a 2-year average of your notice of assessment, which is what you've shown to the bank personally, that you've claimed income personally. They won't look at your business income, but the big banks won't, at least. So if you're self-employed and you're not showing as much income as you actually make, we do have banks that are okay with that, and they won't look at your notice of assessment. They'll just look at the 6-month scope of your business account, business banking account, and they'll look at, okay, what are the deposits, what are the expenses, and we'll come up with an income based off your last 6 months of bank statements. Anyone have any questions on income? No.
We'll save the questions. We can always go back later to the slide if anybody has any questions.
Yeah, we'll do the questions after the presentation. Yeah.
Yeah, income is the biggest part. But credit and income is your biggest parts.
Those are the two biggest factors. So I'll just touch a little bit upon what Nash said. So obviously, the bank wants to know that you're able to pay the debt that you're looking to take on. In terms of, I'm just going to go back to the employed and the self-employed. So if you're full-time employed, all you need is, like Nash said, a letter of employment states how much you make, and the bank wants to know that you're guaranteed, to earn that income for an indefinite period of time. A lot of the times, some people might have started, there's probation periods where, the employer can terminate you after your probation period. But if you are full-time and you're guaranteed a wage, it's obviously a lot easier for the bank to look at and obviously give you an approval. Having said that, though, it is, people do change jobs. So if you're recently into a job and you're still on probation, the bank will still look at that, but what they'll ask you for is a history of your employment. In this case, usually they want to look at and see what you've been doing for the last 2 years. They will also look at, your designation, if the nature of your employment, how long you've been in the same industry for. All these factors will play in. So even if you've started a new job, if you have a history of earning, close to what you're earning, what you're disclosing to the bank, you should have a good chance of success. And with self-employed, now self-employed can, you could be a service person, realtors, mortgage brokers. You could have like a wholesale company. You could have your own, whatever it is. If you're not employed by somebody else, then you're considered self-employed. You could have your own corporation, you could have a master business license, or you could just be billing your services out under your own name.
But this goes for Uber and Lyft drivers
for Uber,
as well.
Lyft.
So they'll look at 2 years. Yeah.
Yes. So when you're self-employed, what they really want is they want to see that you've been doing it for at least 2 years. This is guaranteed. If you don't have a 2-year history of being self-employed, then the bank will ask to see what you were doing prior to that. And again, if you were, there is instances where people are working, like say in the IT industry, they've been working for a company, IBM or something for a while, for 2, 3 years, 4 years, and suddenly they decide they want to switch to being their own consultant. When the bank can see that your earning potential for being self-employed is quite similar to what you were earning when you were employed, you have a very good chance that transition period the banks will look at. You have a good chance of it. And then obviously the documents that we've listed over here, this is just a good, this presentation, it will be available. I think anybody, Asin can send it out to whoever was interested. It's good to keep on hand. These are standard documents that the bank wants to see when you're applying. So if you've never applied and if you're interested, you can start to compile a list of these documents, and it gives the bank a very good idea of
So I usually get a question of, hey, you know what, my wife is on mat leave. Can we still get a mortgage? Absolutely. If she's got a salary, because let's say that she's a teacher, and she's on mat leave, well, there's a job that's guaranteed for her. So all we would need is a letter of employment stating, yep, she's on mat leave. This is her date that she's returning, and this is what her salary is. So no problem. We can use it. And actually, that goes even for long-term disability. As long as if you're on long-term disability, as long as there's a return to work date with a guaranteed salary, you can get a mortgage.
Okay, so on to the next slide. Again, these are common. Nash, you want to touch on. These are some of the common buyer programs available. We just handpicked a few that might apply to maybe people who are interested here. So
yeah.
Go ahead.
Okay, go ahead. Yeah. So an insured mortgage is when you don't have the 20% down, and also insured mortgages are for owner occupied. So you're not going to be able to buy a rental property, and the insurance from CMHC, it's there to help people get into it's there to help first-time buyers get into their own home. It's not there for the investor that wants to get away with putting less than 20% down. So to qualify for an insured mortgage, you're going to have to qualify at today's rate is 5.04%. We call it a stress test. And you won't be paying at 5.04. You probably be in the 2% today, right? But the government has put that as a benchmark for what you have to qualify at. Your credit score, it says minimum here 620, which is true, but I see that banks usually like to see a 680 for an insured. But yeah, 620 is technically what they have on their website, right? But in reality, they like to see a little higher.
And an insured mortgage, there's a maximum amortization of 25 years. It used to be 30, but I think about 4 years ago they dropped it down to 25 years. So that's the maximum amortization. It does impact the amount of your monthly payment. Obviously, being able to stretch your mortgage an extra 5 years would decrease your payment down, as is with the conventional. But so let me just finish that. And the maximum purchase price for an insured mortgage cannot exceed $1 million. So if you're going to put less than 20% down, your property price cannot exceed $1 million. Like Nash said, we qualify at a rate of 5.04 over 25 years. And we have some examples of mortgage scenarios in slides to come up. One other thing that I want to point out is up to $500,000 for a property, you can put down a minimum of 5%. If your property price is over $500,000, then up to the first 500, you could put down 5%. The balance over 500,000, you would have to put down 10% off that amount. So just a quick example, if anyone's taking notes or not. So you have a purchase price of 600,000. You would be putting down 5% up to the first 500,000, which would be $25,000. And then for the balance of the $100,000, you would be putting down 10%. So your total down payment would be $25,000 plus $10,000, which would be $35,000 is a minimum down payment that you can put down.
Yeah, plus your closing costs.
Plus your closing costs, correct.
And I think it's pretty, if everyone is really new to mortgages here and you see insured, let me explain who's being insured here. You're not being insured. The bank is actually being insured from you defaulting, and there's a premium that's added to your mortgage. So CMHC, Canadian Mortgage, oh God, I lost my train of thought. CMHC is the one who gives the default insurance. So what they're saying is, you as a buyer, you're going to be paying this premium that they're adding to your mortgage payment every month. And in case you default, if you don't pay it, CMHC will pay the bank the balance of that mortgage. So it's basically a default insurance for the bank that you're paying.
It's to protect the bank. It's not really protecting the buyer. It's protecting the bank.
It's protecting the bank, right? So you can imagine CMHC is not going to allow just anyone to get into this program, because you that's why you've got to show that you've got really good credit, your income's on par. You got to be a strong candidate for them to insure you.
The conventional mortgage, Nash?
Conventional is different. There's a little more flexibility here. You've got to have 20% down minimum. We can amortize it over 30 years instead of the 25. So that really helps with qualifying you for a mortgage. Also, there is, so working with a mortgage broker, we have different avenues to take you to different banks, right? So if you were to go to a bank with 20% down, they would stress test you, which would mean, let's say they're going to give you a rate of 3%. They'd have to qualify you at 5%, 2% higher, right? With us, if you've got 20% down, we can qualify you at the actual rate that you're paying, no stress test. That increases your buying power by about, it's around 20, 25% increases your buying power, which is huge. Yeah, also if you've got 20% down and you've got maybe not the best credit, we can still help you get a mortgage. Even if your credit's down to like 500, we've got banks that will take those on as long as you got the 20% down. Even if you're like a former, if you've been through bankruptcy, you've been discharged, one day after discharge, we can get you into a mortgage as long as you got that 20% down.
Types of properties, just some of the common types of properties that we like that people focus on buying. I mean, obviously, first thing that comes to your mind is a single family home, whether it's a detached or a townhouse. Condominium is very common for obviously younger first-time home buyers or investors that are looking to rent it out. And then, we have multi-unit residential, which we won't really touch on today. And there's mixed-use properties where there's a residential component to it and a commercial.
We should backtrack a little bit. So, because we said insured, you're not allowed to rent the property. There's a little caveat to that. If you were to live in it and rent out the basement, that's totally okay. Or if you were to live in the basement and rent out upstairs.
There has to be two units. There has to be two units, though. One has to be owner occupied and the other one has to be rented. So if you don't, like Nash said, if you don't rent, you're not able to rent, then you can apply for the insured.
Yeah. I mean, that's just a way to help your buying power, because we can use potential rental income towards your income, and that just increases your buying power to get that approval. I think we can go to the next slide.
No, I just want to touch on the variable rate or fixed rate. You want to just explain that?
So your
It's a common question.
Yeah, so variable rate is tied to the Bank of Canada's rate, right? So it can go up, it can go down. Right now, it's really low, and if you got a variable rate mortgage, you're laughing right now. It's great. Fixed rate is something where it's fixed for the term. So let's say you get a mortgage at 3% for 5 years. No matter what the Bank of Canada, whatever you hear in the news, rates have gone up, rates have gone down, it doesn't affect you. You've got a contract for 5 years at 3%, and that's what it is. Historically, I've seen that variable rates have been the way to go. It's always been cheaper, but it doesn't have that security, right? So it's a personal choice, and it depends on your income, and if you were able to absorb, a little higher, if the rates went up, if you're able to absorb that, then yeah, we should talk about a variable. If you're not too comfortable with that, fixed is always there.
I think one thing that somebody can consider when trying to decide between a variable or fixed rate is their situation, their living situation. If they're buying, if they plan to be in the property long term, if they just want flexible, just peace of mind, don't want to have to worry about payments going up and down. Usually, you would probably look at a fixed rate. But if you're not decided on, and if you want to take a chance on a property, you're not decided if you want to keep it long term. You think you might want to sell it in a year or 2 years or 3 years, then I would probably advise to go for a variable rate, only because the breakout penalties in a variable rate are a lot cheaper than the breakout penalties in a fixed rate. I don't have the calculation to show right now, but the big banks, when you're trying to break out of a fixed rate, they actually charge you the penalty based on their posted rate, which is a lot higher than the rate that they offer you. So the penalties can be quite high. Whereas with the variable rate mortgage, I think the penalties, Nash, what are they capped to? 3 months of interest?
Yeah, it's calculated a little differently. You definitely be paying, like each bank has their own calculation. And honestly, the big banks they're all terrible when it comes to breaking your mortgage. They're all expensive. We've actually got a bank. It's called First National Bank. You can access it through brokers, and they're actually the same as TD. It's the same underwriters and everything. But I actually had a First National mortgage years ago that I broke. I had 4 years left on it, so it was a brand new mortgage. I think the balance was around $400,000 or something, and my penalty to break it was $2,500. If I was with a big bank, you're looking easily close to $8,000 to $13,000 to break that. And I was at First National Bank, which was at the time I had a better rate than going to the big banks. So yeah, it pays to work with a broker, because we've got these tips and ways that maybe you're not thinking about.
Every mortgage product is different. So, you could discuss your options. You can talk about different mortgage products with the broker. And these are good points to obviously point out or bring up. So keep in mind, what's the breakout penalty? If you go for a variable rate mortgage, can I convert it into a fixed rate mortgage if the rates drop? And that is definitely possible as well, to switch over from a variable to a fixed rate without incurring a penalty.
Yeah.
So I think this is
These
a little
are
bit of information.
Very important things to think about, where usually if you walk into your bank, they're not going to be explaining this to you.
No.
But this is very important to think about, because chances are your first home is not going to be your forever home.
Yeah.
You know, so yeah.
We've got a link over there as well. Again, it's calculators. If you get the presentation, there we go. Okay, we'll go to sample mortgage scenario. So Nash, you want to run this through?
I'm not looking at here.
Or maybe I'll explain it, because I
Yeah.
put it there. So these are just sample mortgage scenarios, but the calculations are actually exactly, it gives you an idea of what it looks like, where your, a purchase price, what your down payment would be. And then obviously there's the insurance premium, which Nash mentioned, the default insurance, which the bank charges you. You'd see that's usually between, if you put down 5 to 10%, it'll go anywhere from 3 to 4% of the mortgage amount. And it's always added on to your principal mortgage amount. And then, so you don't pay for it upfront. It is built into your mortgage, and you pay for it. It's amortized over 25 years. You can see the difference between the conventional mortgage putting 20% down for the same purchase price. You see the difference in payment. Rates are a little bit slightly higher on a conventional mortgage than on an insured mortgage. Obviously, because
but you got to think about that insurance premium as well, which is not reflected there.
Absolutely.
So, yeah. 2.59 might sound cheaper, but you're paying a default insurance premium as well, which is not factored in. So conventional is always, even though the rates look like they're slightly higher, you're actually paying less interest.
So we did 4 scenarios, right? We did an insured mortgage at 5% down. Like I said, up to 500,000, 5%. We did a scenario of a 500,000 purchase with 20% down to show what a conventional mortgage looks like. And then we did one with 10% down. If you could just look at the insurance premium, so the more you put down, the lower your insurance premium is. So if you see that you've put down 10%, but your insurance premium is pretty, it's around the same as what it would be if you're putting down 5%. So obviously, helps to put more down. And then we have an option at 35%, and this is an option. I don't think we touched on it, but if there's any non-residents, most of the banks have a non-resident program where you can get in with 35% down, but the maximum amortization for that is 25 years, even though you're putting down over 20%. Okay, so this is Nash, you can go through this. This is a very you must pay attention to. This is a good a sheet because it actually shows you what happens.
Yeah. So the way it's going to work is, first things first, we've got to get an application going. So that can work out as, we can send you our online application. You can fill it out yourself, or we can have a phone conversation while we're talking. Mohamed or I was typing in all the notes into the application. The second thing would be obtaining all your documents. So we have to, whatever we put on that application, we've got to back it up with documents, your income documents, purchase agreement, and just documents, right? The next step would be to pull your credit. So we'll look at your credit, and based on all the information we've gathered to that point, we're going to look at, okay, what's going to be the best fit? What bank has got the best program for you, the best rate, which at that point we will submit the deal into the bank, and an underwriter will pick it up. She'll look at the application, he or she will look at the application, look at all the documents, will approve it, then send it off to their manager, who will do the exact same thing. They've got like a double check, right? So the manager will have to sign off on it. And then you will get the mortgage commitment, which is the document of your approval. We'll go over it with you, show you all the prepayment privileges you may have, all the terms, conditions, You would sign. After you sign, we would have to assign a lawyer to help you close this transaction and register this mortgage. And then your closing date comes along and you go to the lawyer's office, pick up your keys, thank Asan for all his hard work, and enjoy your new house.
Now that's if we get a successful approval. But what happens if the bank didn't approve me? So there's a few things. There can be a variety of reasons that the bank may not approve you initially. Not to say that they won't approve you, period, but the factors affecting their decision are listed. Some, it could be a lower credit beacon score. Maybe your income is not enough to support the mortgage amount that you're requesting. You might have had late payments on your credit bureau. Maybe you paid a credit card late, or a car payment didn't go through. You might have had a previous bankruptcy, or you might have filed a consumer proposal. Very rare instances, there might be actual problem with the property that you're trying to buy. There's if there's been some criminal activity at the property in the past, or if there's structural issues, the bank may decide to not approve the deal. There might be, nature of employment. This is again very rare, but sometimes you get, where people are working, but they're earning cash. They're not depositing income in a regular way as what the bank wants to see, where normal people get paid, by a check or a direct deposit, or they're filing their income properly. The banks will not look at cash income as a form of income. So those are some of the factors that might affect the decision. And the most important thing is, well, what are you going to do if this happens? So there are solutions. Obviously, there's always solutions to get an approval. It can, you could try lowering the loan amount if the income's not enough. You might be able to add more down payment if you have access to that. You could have a co-signer or guarantor, maybe a family member, or some cases a friend that might be willing to come on, whose additional income we can add to the application. There's also other lenders, alternate lenders that have different criteria from the lender that you're at currently, that might take a more sympathetic approach to looking at your application. And then obviously, if you have equity, or if you have a sizable down payment, there's also private options where there's private lenders that are not governed by they're not governed by an individual body like how the banks and monoline lenders are. These are just private individuals that are willing to give out mortgages. The interest rates are obviously much higher than what you would get at a bank, and the private mortgages are they're like bridge situations. So most you can get a private mortgage for is probably 6 months to maybe a year, and in that 6 months to a year, you're trying to correct the situation that you're in, which didn't enable you to get a mortgage from the bank. And then obviously, if there's an issue with your credit, then you speak to a professional maybe who can advise you on how to rebuild your credit. Sometimes it's just a matter of time, rebuilding your credit score and then going back into the bank 6 months or a year later, and your credit score has gone up, and the bank has a more positive approach to your application.
Mm-hmm. Yeah, it's another reason you should use a broker. So if those problems pop up, could you maybe go back to the last slide, please? So see where those problems are. There's some possible problems, right? So that's what Mohamed and I deal with up front. Before we send it to the bank, we're not going to send a file to the bank with problems. The way we send it is, if we do see a problem, we'll talk about it with you. We'll find solutions. We'll really polish up your file properly. We know what they're looking for. We know what you need to do, and we can help you take those steps. So we won't submit your file until everything's really ready for an approval. So that's where we come in. That's where our knowledge and experience come into play to help you. If you were to go into just a regular bank, in my experience and other people's experience have told me, is they'll just pull your credit, take whatever you have, and it's either an approval or
no approval.
Yeah, it's very cold. Where with us,
We know what they're looking for. We know what the bank wants to see. We know how they want the information submitted. And so we prepare you. So I think I forgot to, as an important point on the top right there, the pre-approval. So obviously that's a term that you see thrown out there. How do I get pre-approved? So a pre-approval it's kind of like an approval, but it's not really a firm approval. It is just a chance for the bank to initially just review your information, and then, without going into a full underwriting process, they're able to hold a rate for you anywhere from 90 to 120 days. A pre-approval is handy because it means you're 50% there. You're not all the way there. Obviously, things can change between the time you actually get a pre-approval to the time you want to make it a firm or conditional approval. But it does help to actually get pre-approved, because when you speak to a broker like myself or Nash, we'll ask you for all the information that we need to build your application and to package all your documents in the right way, obviously to give you the most chance of success. Some useful links. It never hurts to, I know probably most of you have a little bit of time. We're all quarantined here, but this is some interesting reading. If you're a first-time home buyer, if you're looking to buy a house, I would definitely go and read up on it. It'll probably touch a little bit more on what we've said and probably give you a lot more information and resources that you can
absolutely
use. I think that's I think we're good at. What do we have? Oh, we're 12:47. Asin?
Yep. Yeah, thanks guys for the presentation. So what I'll do is I'll open up the floor now. So if anybody wants to ask a question, just go on unmute and just feel free to ask the question, and
fire away.
I shall do the best to answer. If you want to type your question, you can type it out as well.
Yeah.
Go on unmute and just ask. So go ahead.
Yeah, no problem.
And our information is there too. If you don't feel like you have any questions right now, feel free to reach out to us, email, phone, WhatsApp, text. We're happy to.
We should also mention that working with a broker, you hear that, sometimes you got to pay a broker and stuff, but
that's very good.
Yeah, if it's just if it's just a regular file where we're just putting into a regular bank and helping you with that, there's no charge. The charges come usually if we've got to put you into a private mortgage, or maybe it's a commercial file, something that's difficult like that, something different.
There's no fee to work with the broker, basically.
Yeah, it's completely free.
We get paid by the financial institution that we take the mortgage to.
Yeah, and they all pay the same. I mean, it's not like we have a preference to bring you here or there. We're going to bring you where your best fit is. And,
where your best fit is, exactly.
Yeah, and I mean, I know we're working virtually now, but usually when I have a client, there's a program that we have that will show you transparently right on our screen all the different banks, all their rates, everything, and then we go through and we say, okay, here's what everyone's got. Here's what I think is best for you. So it's totally transparent, and it just gives you.
It's informational. It's knowledge. Like, you can pick up a lot of information working with a mortgage broker. Like he said, I mean, don't get me wrong. There's a lot of mortgage brokers out there, and everybody works differently. But with us, we're talking about us. We're pretty transparent, and we're out there to help you. Whatever information we have, like useful information, we pass along, and we educate along the way. So once you've gotten a mortgage, you're much smarter about the whole process. And if you ever have to go through it again, you're very well prepared. You know exactly what you need to do.
I had
I
a
think
question.
that's a big, yeah.
So you're talking about the 10% or 5% and 20% down payment. Let's say as a first-time home buyer, I decide to put down 5%, but maybe in the next couple of years, I want to top it up and add some more down payment to lower my mortgage amount and lower my insurance premium. Am I allowed to do that? And if I pay a penalty?
I don't think the insurance premium's tacked on right at the beginning of the mortgage, but the prepayment privileges will allow you to, I guess, pay up to 15, depending which lender is 15 or 20% of your principal without a penalty. You could then you can actually, Nash, can we get it re-amortized over once you hit 20%?
Yeah. What I would do is if there's enough equity that's built up over the years, let's say you've got a 5-year term, 3 years have passed, your property value has shot up, just refinance. And to avoid the penalty, we can just keep you with that same bank, right? And just refinance, make it into a 30-year. If you want, we can pull out some money, like actual cash, or give you a home equity line of credit, which you could use for purchasing more property or use it towards your business or go on a vacation. So yeah, once you start building up equity, we can get rid of that CMHC premium, we'll refinance it and get you out of there and start building wealth in real estate.
I think a question here. You can go ahead and ask the question if you'd like.
Yeah, thank you. Assalamu alaikum, everyone. Thank you so much for your time and for your insight into all of this mortgage, which is not usually covered within the normal school system. I had a question regarding, given the current situation regarding the economy and the lower interest rates that are going on, how do you see this impacting mortgage rates? How do you see this impacting home buyers that are looking to buy within the next, say, 5-year time frame?
For me personally, right now is a buyer's market. If people are listing right now, chances are they need to sell.
They're desperate.
They're pretty close to desperate. Like they've got to sell. So if you're looking to buy, I wouldn't wait 5 years. I would do it now. This is the time you're going to get your best deal. If you've got your work going, if you're not at home, laid off temporarily. If you're working and everything's normal,
rates are low. Rates are low.
You can negotiate right now the best you probably ever could before. So I think right now is a great time for buyers.
And Asen, I think you might be able to touch maybe on where do you think the market is heading in terms of real estate wise. From a mortgage perspective, I can say that the banks are still lending. Rates are still low. It's affordable. I think the biggest factor right now with the banks, obviously with the whole COVID situation, is income, interruption to income. I think that is really what is impacting how the banks look at it, approvals. But I mean, maybe you can tell us how this is impacted in terms of the market. Are we looking at, is it stable? Have we dropped? Are we looking at further drops? What do you think is happening?
Right now, obviously, like Nash said, whoever's in the market right now needs to sell their homes, right? Because either they've already bought a home or they're trying to liquidate their assets. So it's a favorable time if you're a buyer, because just a month ago, if you were in the market, there was basically, you were fighting for a property. There was like 5 or 6 bidders on one property.
Yes.
Very difficult to secure a property. Whereas if you go in now, you can negotiate a pretty good deal below market value. The only problem is that, yes, sales have gone down and people are selling desperately. There's no inventory. There's very limited inventory.
Right.
So what's happening because of that is that because there's low inventory, the prices year over year have been stable. So we haven't seen like a huge price drop.
Right.
the biggest advantage for a buyer now is that, you know, they can actually go in and negotiate one-on-one. They don't have to, you know, bid for a property, and it's very stressful and emotional for when it's a seller's market.
Right.
You bid for like, you know, 4 different properties, you lose on them, and then you just, you know, come out kind of deflated, right? So that's the biggest benefit nowadays. I mean, where the market is headed in the next 2 months, honestly, we don't really know, because it all depends on how long COVID lasts. Obviously, the longer it lasts, you're going to see more and more issues, I guess. But if this thing dies down in the next 2 months, I think we're going to be headed into a pretty balanced market in the summer, most likely. But again, that's just my opinion. Dealt with this situation before, so it's tough to predict exactly how it's going to go.
Yeah, again, and it's going to take a while because the government has lowered rates as low as they can pretty much lower them without going to zero. So it's going to take them time. Once we recover, the rates are not going to skyrocket back up. They do it very gradually. So for the foreseeable future, we're going to be in a low rate environment.
Yeah.
It's going to be good.
Definitely.
We have
And
a
the
question
demand will
from
always be
Imad.
there, though. Yeah, go ahead.
Imad, go ahead.
Welcome, guys. So my question is, so reading like the American news about mortgages, and we see that there's 3 million Americans that are not paying their mortgage, and I feel like it's probably the same. It's probably around the same number for Canadians, right? So, do you think that lenders are going to tighten up their like requirements and their criteria?
Well, we already have. So we've got that stress test that was implemented about, what is it, like a year and a half, 2 years ago?
Yeah.
So actually the states have just implemented that very recently because of this COVID-19. They've got basically like a stress test, and they're saying you've got to have a minimum of 700 credit score. This is what I've heard. I'm not a broker in the States, but this is what I've heard. But we've had that for over a year already. Since that's been implemented, it's already been tough for people to get into the market because you've got to qualify at 2% higher. So I don't see the Canadian market going tanking and going down.
We have a pretty stable banking system. I think the banks and obviously the government are aware of this. I mean, we've got the mortgage deferral that's been happening. Banks are okay with it. You know, the government is propping up the banks. They're buying back mortgages, correct, Nash?
Yeah, absolutely. The government will do anything in their power to keep the banking system going.
Yeah.
I mean, they will not let it fail. It's like they're giving people $2,000 a month to make sure things, you know, they're doing everything they can.
I think with the stimulus that they're putting, I really don't see any kind of collapse in our housing market or banking sector for that matter.
Yeah,
I think we're going to hold up, and
we'll definitely hold up. I think you might be able to get some nice deals out there because individual people might be in like a private mortgage situation where they have a high interest loan from a private lender, plus the bank mortgage, plus credit cards, and they're not working, and they're only getting like $2,000 a month from the government. That's where those sort of people are gonna, you know, fortunately, it's gonna be tough for them, and they probably will have to sell, and that's probably where you're gonna be able to get your deals. But for your average person who's just got, you know, a regular bank mortgage, they can defer it for 6 months.
yes.
So I don't see it. I don't see our market going tanking or anything.
I see. And also just a follow up. So for deferrals, does that go onto your credit score?
So
A good question.
If you were to get a deferral, I would get it in writing that the bank is giving you that deferral and you're not just missing your payment. So just in case, if it gets reported to Equifax that, hey, this person's missed their payments, you can go right back to them and say, hey, here's the document straight from the bank. It was a deferral. It was not a missed payment. So definitely get your stuff in writing. If you're going to defer, get it in writing.
I think what's happened, some of the bank, I don't know if they were ever ready for something like this, but the way that the banks report to the bureau, I'm not sure if every bank has updated it or if they've kept it the same, but if the deferral payment might show up as a late payment on your bureau, but like Nash said, it's good to have something in writing. And I believe with how many people that have already deferred their payments, I believe when it comes time, you know, obviously for another bank to look at your credit, and if they see that on there, I mean, given the time references, you know, when that happened, I'm pretty sure that I think everybody's deferred. Like a lot of people have deferred the mortgage. I don't think it'll be that big of an issue, but like Nash said, it's always good to get it in writing.
But and you know what, me and Mohamed work with the banks daily, but you know what? I wouldn't trust them because you know if you get it deferred and you don't get anything in writing, and they put it 4 months late mortgage payment. Let's just say you get 4 months on your credit score late, even though it was a deferral. Let's say you're with RBC. RBC is going to be the only one that knows that was a deferral. If you try to go to another lender and get a better rate, they're going to say, no, thank you. You missed 4 payments. So make sure if you defer, get something in writing.
There has to be a contract. They make you sign something, right? Get
it in writing. Don't defer without having something in writing from the bank, because that might limit your possibility to move to another bank when this is all over.
Right.
Because that missed payment stays on your score for 7 years.
Yes.
So it's really important to not have missed payments on your credit, because it can hurt you. It hurts your credit. And if they do it by accident, you've got a paperwork, bring it to Equifax, and it can be sorted out.
Thank you, guys. Appreciate your time. It is 1 o'clock right now. So if you guys have any other further questions, I'll be posting Mohamed and Nash's information later on. I'll be emailing it to you guys. So feel free to reach out to them for any of your mortgage services. They'll be able to help you out. And then, yeah, we'll continue with these sessions on a monthly basis, and I'll reach out to you guys for feedback and some other topics as well. Thank you, Mohamed. Thank you, Nash.
Thank you. Thank you, Axon. Thanks for having us on. Thank you very much, everybody.
Take care, guys.
Take care, guys. Thank you.
Have a good day. See ya.
Bye.
Bye.
Have a nice day, guys. See ya.
Allah Hafiz, guys.